Welcome. Today, I'm diving into Goldman Sachs' recent outlook on the S&P 500, a view that's stirred quite a reaction. Goldman Sachs has indicated that the era of big gains for the S&P 500 might be coming to an end. This forecast is based on nearly 2 decades of S&P history and suggests that future returns could stabilize closer to an average level. Naturally, some people are concerned. It's easy to worry when we hear predictions like this. There's a human tendency, well known in behavioral finance, to respond more strongly to potential losses than to gains. In the psychology of money, there's a line I love: pessimism sounds smarter and more credible than optimism. Yet, looking at human progress, it's often optimism that prevails. Prospect theory reminds us that humans are wired to react more strongly to loss, a fact that's crucial to keep in mind here. Now, back to the Goldman Sachs forecast itself. Their model is based on the S&P's 10-year returns, factoring in macroeconomic indicators like interest rates and earnings per share rather than stock prices directly. While this provides some insight, it doesn't fully account for unpredictable events, like the financial crisis of 2008. Relying too heavily on these indicators can be risky, as even macroeconomic forecasts have their limits. Looking at some past predictions, we see this unpredictability play out. In late 2021, Goldman Sachs forecasted the S&P 500 would hit 5,100 by the end of 2022. Instead, we entered a bear market. While Goldman Sachs analysts are highly skilled, even their forecasts are limited. There's a difference between intelligence and accurate prediction, something essential to remember to avoid becoming overly swayed by headlines and forecasts. This brings me to my approach. As often discussed in a random walk down Wall Street, a professional portfolio and a randomly chosen one often perform similarly over time. This is why index funds are powerful tools. They bypass high fees, diversify across the entire market, and support long-term returns with lower costs. In terms of my investment strategy, I keep things simple and focused. I invest in the S&P 500 regularly, unaffected by market fluctuations. I prioritize tax efficiency, balance risk and return, and aim to grow wealth over the long term. My priority is maximizing time in the market, holding steady to encourage sustained growth.